The bad feelings last for a day, and the 5 billion lasts forever, right? So you'll get over it.
Boys, it has been a big week of news. Anthropic's inference costs skyrocket, Brex's $5 billion deal, and the $12 billion OpenEvidence round.
At some point, NVIDIA puts will be a great buy because every semiconductor cycle for the last 40 years has ended up in a massive downswing. I ain't buying them today.
We talk about is SaaS dead or what's going on. I worry this is the next final act. I think it's the final nail.
Is there a way out there?
Most of the time, we sit around here waiting, reading, and thinking. And I thought, that's a real investor. Understands that activity is not everything. SaaS is not dead, and now SaaS has an army. I love it.
Ready to go? Boys, it has been a big week of news. Now, I was super happy when this news came out because I got tagged on so many being like, can you do an emergency pod? And I was like, well, that is a great sign of product market fit for what we do. And so we're going to start on Brex's acquisition by Capital One, $5.15 billion, 50% cash, 50% shares. Diving right into it, how did we analyze the announcement of this, which did come as quite a surprise to many of us?
I thought it was a great outcome for the company. By the way, no one, and obviously everyone who's on this pod has probably heard all the thread. First of all, you have the great outcome people. Then you have the people sneering saying, oh, that's a disappointment from where they were. Then you have the counterpart saying, grow up, kids. Anyone who builds something from nothing to $5 billion, it's a great outcome. Shut the up. And which, by the way, I think is the right outcome. So let's assume everyone's already caught up on that so we can kind of engage from there, right? Going back to the first thing, I think it was a great outcome. And I think, you built something from nothing to a $5 billion outcome before you're 30. Heroic result. Absolutely be praised. I think it's a smart acquisition for Cap One too, by the way, and we can come back to that later. But that's kind of the first big picture comment here, right? And then on the second thing, and I think there's three different sets of comments. There's is it a great outcome in the abstract? Of course it is. Second big picture question, is it a great outcome relative to the $12 billion raise in 2021? And there actually my co-podcaster, Jason, I thought did an awesome piece on that, and we should talk about that next, hubristic financings. And then, by the way, the last thing we'll circle back to is it a great outcome relative to ramp and the competitive dynamics? So I'd like to throw it to Jason and say, I thought your post on hubristic financing and the pros and cons of raising at 12 and selling at 5 was actually really good. So over to you to get your thoughts.
Look, I don't know everybody like Harry does, but someone that was a smaller investor in the company, I asked what she thought, and the outcome was, well, given where we are in the world in 2026, it's a good outcome. And that qualified answer kind of was interesting, and so that was my thought. It's like, there's so much. I mean, listen, some folks are taking pot shots on X. That's the way it is. But why do we have these weird feelings? Why are we not sure if this is a good exit at $5.1 billion in 8 years? I mean, I would have loved to have led the seed round, right? Maybe it's not good enough for Harry, but Rory and I would have been happy to have led the round, right? So why do we have this feeling? And look, this is nothing new. This is the era. I called it, hubristic financing. You've got to keep doing these Harveys and Lagoras and open evidence from 1 to 12 to keep up. And if you don't, you put yourself at a competitive disadvantage, but then you set yourself up for disappointment. Because these companies that are fundraising to the nth degree, the thinking machines today, the Brexes back then, they are promising, as Rory says, this 0.1% growth ad infinitum, not just a couple years of sustained growth. Brex was basically promising it would own all of business finance at some point, and that was the bet at 12. And so it leaves us with a weird feeling when put the late stage investors aside. On paper, all other stakeholders have a great outcome. Even the liquidation preference, it's not like it ruined the deal, right? They raised like $1 billion something equity and debt. This wasn't one of the grouchy deals where $7 billion went into the company, right? This was a great outcome for everyone on paper except a late stage, but it's versus the promise, the commitment made to everybody, customers, late employees for 4 years. But do you have to make these promises to win today? Do you have to make them to win today?
When you take money at a high price, you run this risk of subsequently exiting at a lower price and having this weird, odd feeling for a day. But I think the wider level comment is step away from the weird feeling, right? I thought the thing you wanted, why did you raise money at 12? I mean, going back to 2021, who's going to say, investors are offering you money at 12. No, I'd prefer to take it at 6. Thank you very much. I'm an idiot. Right? No, you raised the money because you needed the capital. If they had, let's run through the logic here. If they haven't raised the money, they would have run out of money. That would be dumb. Once you need the money, you're going to raise it at a market price. So I thought what you said is, look, there's pros and cons to that. You get the buzz, you get the momentum, you get the employees, you get to compete in a world where other people are doing it, right? And in return, you pay this weird one-day tax the day you exit, which is you've just had a heroic, world-changing, life-changing event, and then you just feel weird. But given what's on the field, there's no way to avoid that because you had to raise the money in 21, therefore you did market price at the time. The bad feelings last for a day, and the $5 billion lasts forever. Right? So you'll get over it.
No, we're actually, because I'm going to get a Capital One card in the mail as soon as this deal closes, we're going to forget about Brex in 24 months. We're going to even forget whether it was 2 X's or how to spell it. This is our world. We'll forget, right? I will say just one thing on the topic. Look, great outcome for the founders, right? On many levels, great outcome for early employees. Not what they thought they'd make in 2021, but a great outcome for Ribbit. The one thing, in addition to my post, I saw that not too long ago, but a while back, Ollie from Databricks said, which is one of the most successful companies at this strategy, Hubridix, he said, I never wanted to raise more than 2 years ahead of the valuation I was confident I could hit. I never wanted to raise, not just 2 years ahead, not just the classic, the VC side is, hey, listen, 1 year ahead for a hot company, 2 years ahead for a great company, maybe thinking machines 28 years ahead. I don't know, but that's a thoughtful response. Like, if you believe it, did Brex believe they'd be worth $100 billion? Probably. I don't know. But things were loopy in 2021, and maybe they're loopy in 2026. But
they probably did because look, it's the sin of extrapolation. The growth rate was probably 200-300%. You extrapolate. It's the age-old truth. Most of these quote-unquote insane valuations can be explained actually by the Ali comment. Provided I keep the growth rate up for 2 years, then I will have grown into this valuation on a revenue multiple basis. It's a perfectly innocuous sentence, but buried in it is a whole debt trap because the minute 22 came on, the growth rate faded, right? Then your capital gets more scarce, so you have to try and converge on profitability. So growth rate goes down even more. And, what was a totally legitimate belief in 2021, which is 3 more years of 300% growth and I'm worth $12 billion, becomes utterly insane in 2024. It's just the cost of doing business in this crazy game that everyone plays. Right? Because I suppose what I'm trying to do is I'm trying to avoid this kind of moral, it was good, it was bad, all these emotion-laden things. If you play the game of to something, for example, for the late-stage investors, if you play the game of paying up massively for hyper growth and it doesn't work, you get a 1x, right? Now, as long as maybe 30-40% of them are the 1x and you don't do any major whoopsies where you actually get a loss and you get a 3, 4, 5, 6x on your good uns, then overall the math works. And even in a mediocre year like 21, you end up with a sub 2x, but still perfectly fine fund. In other words, I go back to my comment. It's just the nature of the business. It's one of my things that I've said a lot in this pod. Things prove up in the end for what they really are, not what you delusionally think they are at one point in time. In the end, a financial services company was always going to trade at a financial services multiple adjusted for growth. And that's what happened here. So growth came down to still very impressive, but normalized levels. Cap One leaned in and said, $700 million in growth, plus or minus 7 times revenues. That's a good deal for me. Done.
How does this change the game for Ramp? Ramp obviously raised at 32. Does this help or hurt them?
I think this is a great question because remember I said there's 3 things. There's the is it standalone a great outcome? And then, of course, is it a great outcome for the investors versus 2021? You're raising the third one, which to me is the actually Ramp, and I've got to say it, the CEO of Ramp did a fairly classy post. It's like, hey, congratulations. he had sold a company to Cap One. It wasn't awful, right? The Founders Fund guy did a dance on your grave post.
Dude, I love Eric, and I do. Yeah, I like the team there. It was a dig. I know some good lunch.
It was a dig, but it wasn't a top. But perhaps, as is so often the case in America today, I'm judging quality by the opposition. The Founders Fund did a straight dance on your grave. If I'm Ramp, from an operation, I mean, the two things are true here, guys. From an operational perspective, this is further validation that quote unquote I've won. I started later and I'm doing $1 billion. They started earlier. They're doing 700 million. Good news, you've won, right? But the bad news that you just can't ignore with a tweet is when real money decided not to buy 2% of this thing in a secondary sale, but to actually write a check for the asset, they said we're going to multiply by 7, right? And if you multiply Ramp's $1 billion run rate by 7, you get 7 billion. Now, they're growing faster than Ramp, maybe double it, 15. What it points to is, we live in this crazy land of VC valuations where they're made once a year when only one person buys, no one can subsequently sell. They're very thin markets. And, we hope they're roughly right. And sometimes we're surprised to the upside when they go public, and then sometimes we're surprised to the downside. If I was hard comment here. If you're doing your mark to market on Ramp right now, how do you factor in a recent transaction at 7 times to your multiple of 30 times? It does at least, I'm not saying it's dispositive because you're faster growing and you did, as you put it, win, but it does make you think maybe when you go public in 2 years and you want to monetize let's say at that stage, $2 billion revenue company, maybe you're still growing a little faster. Maybe you get 10 times. I don't know. But it does, if I was the investor in Ramp, or if I was the investor who just wrote the $32 billion check, I'd at least pause and go, let me check my assumptions one last time here, right? Maybe it can still work, but I got to be a big company. You ain't going to get the M&A outcome anymore. You've just got to be the big company and trade in the public markets at a significantly higher multiple than the other financial services companies. The only way you can do that is if you keep the growth up. So it's not like it's impossible, but it's just a significant data point that weighs the other way as you think about value.
If I'm the Brex founders, right? If I'm Pedro especially, Ramp, we talk about Ramp, but we also look at Navan, public, and I have another comp going to Rory's point. And I'd be like, let's say the three of us were the founders. I'd be like, Jesus, we have a comp that's basically worth the same as us, basically the same revenue. Now it's got debt, it's got other issues, but I'm like, my God, guys, we could work for 3 more years to an IPO, suffer lots of dilution in the IPO, stress, and basically economically be the same place in 3 years. Now that's cool if the three of us want to build something much bigger than this, right? But I don't even know if 10 billion is worth it. If we don't want to do it, if we don't want to build this as a generational company on our own for a decade, because the Navan comp's a tough one. It sort of says to me, we're going to grind it out for 2 to 3 years and be worth the same. So we better want it. And all my public company CEOs they're pretty grouchy today. I would say 80% of the public companies, B2B CEOs now they may be thrilled when the next generation IPOs, but this isn't the happiest cast of characters, is it? The public company CEOs? They're not happy today.
But it's a super good out. I think Cap One have played a very shrewd hand here. Because remember, all these businesses, Ramp, Divvy, which my former company I was formerly involved with, Billboard, Brex, they all monetize on interchange, right? And most interchange is Visa and MasterCard, which is, third-party network. You have Visa, the issuer bank, and the accepting bank. Capital One bought Discover Card. Discover Card has a closed network where they get all the money in the interchange, right? So that's a really powerful asset for them now with now that they have Brex. They will probably be directing as much of that money flow onto their own rails, as the bankers call it, as they can. And what that means is they'll be able to extract a lot more of the value from it. So this could be an example where the asset is worth more to Cap One than it was on a standalone basis. So I think it's a very shrewd acquisition for Cap One. In the last, in the last 5 or 6 months, they bought Discover less than 6 months ago. I think it closed just recently, like for $35 billion at announcement, $50 billion at close. And now they bought Brex, which they can fold on to Discover. So they're making a real push into this space, which is another thing you got to think about as the independents. You're sitting there going, I'm going to be playing against the A team now with a structural cost advantage. You had 3 pieces of news today, investors in Ramp. You clearly won, and the other guy said you won. That's good news. Tick, put that in the positive column. Second piece of information, people think a company going a little bit slower than you and roughly the same business is worth 7 times and you think yours is worth 30x. Put that in the negative. And then last, a well-funded public company competitor is directly entering your space with a structural cost advantage. Now, you can hit total on that and decide my impulse at the end of that is to tweet and say, well done. But deep in your soul, you kind of go, not sure that was the best day out there for my stock.
At least stay private longer.
You're going to have to, big guy.
At least
you're
live in the dream world of private. Let's do another secondary, boys, lads.
Okay, moving on, boys. Another very, very significant bit of news that we've all been waiting for a long period is TikTok deal finally done. US investors will own 80% of the company. Algorithm retains in control of Chinese owners, which is interesting. How do we analyze this deal getting done now, and how do we think about it?
I think you can't approach this deal economically in the main. You have to. It's a political / geopolitical decision to force TikTok to divest, and when you have that, and then have a very directed purchaser program. So let's do the economics first of all. It looks like a very attractive deal. I think the company's doing $15 or $16 billion in the US revenue, and they bought it for one times revenue plus or minus. That's a wildly cheap deal compared to anything else. Now, there's a term that says some portion of the OpEx is a license fee or some payment back to the Chinese parent. So you don't know the full economics, but my sense is that it's a wildly accretive deal for the lucky chosen investors in the new oligopolistic capitalism that we now practice. And it is worth pointing out how wonderfully, it's good to know that we so that's it from an economics perspective. So fundamentally, ignoring any other questions, I wish I had some of that in my 401k. Right? The most addictive, popular application in the United States social media marketplace at 1 times revenue. Put me down for some.
At first, when I saw this deal, I thought, and Rory can play historian here. It harkened back to me to when Andreessen got off the ground doing Skype.
Yes.
And the reason it was a structurally weird deal where they got a good deal. Now they took risks. Skype was a aging platform, but they bought it from eBay, right? Is that eBay needed to divest it? They had enough of it.
Very shrewd deal.
There was no synergy, and Andreessen went all in. They didn't have that much bad in it. They went all in and 3x net their money in like 12 or 14 months. This felt like another moment in time where you could get a great deal. The only thing I don't get is why didn't those guys show up? Why isn't Andreessen and Sequoia and Lightspeed in this deal? And you have weird ones, Oracle, which also has infrastructure. You have UAE sovereign wealth funds. Where are Sequoia and Andreessen? That's the only thing that made me pause and maybe it's not such a great deal. Because those guys are just in the business of minting money now. Why didn't they each at least throw in $1 billion or $2 billion into this deal? They put it into everything else.
I don't know. Maybe it was a bit of I don't have yes, because at one point they were in it and then they were not.
There's a reason they're not in that deal. It's free money otherwise, right? We're missing something.
And they're not averse to structurally challenging deals like X with Elon taking over, which they all engaged in.
No, totally. And I think I remember them doing the Skype deal. That's a very shrewd deal. And I want to say that the PE firm brought them in because they had kind of venture expertise, which was, again, don't quote me. I think the PE firm was in fact Silver Lake again, but I'm going from memory there. But I remember, as you say, Andreessen came in on the deal. It was spun out from eBay. There were some issues around licenses and IP, and it was a little bit risky. They cleaned it up for 12 to 24 months and then sold it to Microsoft and made 3 times the money on a ton of money in their first fund. So super shrewd that was. And if someone does the same thing here, it'll be interesting.
Let's move on. Let's discuss Anthropic. Anthropic inference costs 23% higher than expected. Are there economies of scale in AI after all? And how did we read this?
Look, there's a lot here, but I think this is so important for B2B companies. Literally, I was at a board meeting of a B2B company with a powerful AI agent costing $100 million, and just seeing some of the dumb points in this board meeting of saying, hey guys, in 2026, we've really got to drive down inference costs now. And I'm like, do you realize you have 6 mega funded competitors and a huge amount of the only differentiation is who has the best agent. Now you're going to cut back your inference? It doesn't make sense, right? And this is the point Amjad was making so many times, I'm sure Anton from Lovables made his own version, but Amjad's always been like, no, everything's going to get more expensive because as soon as we figure out how to do this stuff, we're going to burn even more tokens. We will actually burn an infinite amount of tokens if we can. It even happened to Anthropic, right? It happened to everybody. And I think for a lot of folks, especially folks that aren't quite growing it at the OpenEvidence levels today, or ramp, are thinking, God, what am I going to do with these inference costs? And I got to tell you, the idea that you can use cheap models and cut back on your inference and still be competitive, that's the thing. Still be competitive with the hot Andreessen funded company. Like, no chance you can be competitive without that inference.
But I do think it's important not to lose sight of the fact that even though, I mean, you asked the question, oh my God, the Anthropic inference costs were higher than expected. Is there any leverage with your rhetorical economies of scale, Harry, right? The truth is, remember, last year they had a negative 94% gross margin, and this year they have a 40% plus or minus gross margin. Now it's not 50. So clearly the gross margins are improving substantially. So I think the real kind of in the middle boring comment is there is significant leverage in inference costs, and the P&L is getting a lot better. But it may not go all the way to it may take longer. We thought we'd be at 50, now you're at 40. It may take 2 years to get to 70, or you may never get there. You may asymptote out at 60, right? So I think it's just the nature of the beast. And you're dealing with this totally new business product, totally new market. You don't have you have a hypothesis on where things kind of shake out, but it may take a while to get there. Fundamentally, however, I don't doubt the fact that a profitable and defined by that as free cash flow, operating income business will emerge from something like, I mean, Anthropic's not going to not have a profitable business model because this clearly is converging. It's just a question of, what scale does it converge at and what operating model does it converge at? Is it a 10% operating margin business or a 30%, right? So it's getting better, but it's getting there. It's getting there a little more slowly than you might like but it's still massive. I mean, from negative 94% margins last year to positive 40 this year, that's a big move.
I can ask Jason specifically to you. You said at the end of the year when we did our kind of quiz show on Roundup, you said that 2026 would be the year where we would see inference running for 24 hours a day for a small portion of the knowledge economy. And I thought that was a really interesting takeaway. When you think about that,
I actually tried to build it over the weekend.
When you think about that combined with these increased inference costs and being more than expected, how do you think about those two together?
It's easy to say we're going to use 3 orders of magnitude more inference in 24 months. It's easy to say, it's more than an order of magnitude by the end of the year, potentially. The cost decline that we're also seeing, despite the Anthropic thing, it's hard. The token consumption is increasing the deflation in the per token cost. So we've seen that improvement, I think, at Anthropic, to Rory's point, and I might be getting it wrong, but we haven't seen this break point where we're catching a break. Maybe the margins are getting better, but we're going to keep burning more. So I'm waiting for the moment, but I'm not seeing it. We've talked about memory, but ChatGPT and Claude don't have that much memory. If you try it, don't remember much, does it? It remembers this little bit. So I built a version of Claude over the weekend called Ren. You can try it at Ren, WREN chat.ai. And it remembers everything. It compacts everything, so it never forgets anything. And I learned a lot of things, but one of them is it's going to burn a lot of tokens. If you want to save every chat you've ever had, every discussion over all time and reference it for years. And what if that runs 24/7? Maybe I'm rambling and not answering your question, but I just see it accelerating. And again, my biggest concern for founders out there, especially for folks that are not quite in the top 0.01%, right, is just that they're not, especially folks in ops on their team or folks that aren't close to AI, that they're mismodeling this. You need to model, and your inference costs are going up this year, not down. If you walked into your board meeting and said, hey, good news, guys, inference costs are going down 30% this year because our IT team's really good at managing costs, I would throw my mouse at the monitor.
You are right, but kind of at the risk of I have 2 zoom out comments on that. First of all, when you look at the problems you'd like to be wrestling with as a business, an individual business or an industry, the problem of I have infinite demand for this digital good, which is still quite expensive to produce, so we're going to have to figure out how much to charge for it and how to ration it, is a wonderful problem compared to no one wants to buy this digital good, I don't know what to do. right? So you're right. I mean, what you're saying, Jason, is correct. The demand for inference, the demand for tokens can be almost unlimited in some cases, because the more you can deliver, the more you can do. So metering that demand relative to the cost to produce is, as it were, the business challenge. And you're seeing that across the board. I mean, in Anthropic, you're seeing all these, the $200 plan, the $20 plan, and then they have those few people who are doing $1,000 of tokens on their $200 plan. And what do you do about that? So, but again, so that's what's happening out here, which is everyone's trying, and that's if you're the model producers. If you're a SaaS vendor like you and I are investing in, an AI apps vendor, and inference is one of your biggest costs now. It used to be 5 years ago, AWS would be one of your biggest costs. It would hit 10% and everyone would lose their shit in the board meeting, and you'd say, let's get it down. And, you'd manage the process and get it down to 8 or 9 with efficiencies. Now you're right. It's inference is the big cost. If you're a high-priced app, maybe it's 10 or 15%. If you're a coding type app, maybe it's 50, 60, 70% of your revenue. And if you don't manage that correctly, you don't have a business. So, but again, I think you're exactly right.
But I do think, I do want to get your thoughts, Rory. What I worry, and maybe it's at a practical level, I worry there's this middle category. These are mature company, not hyper mature, 50, 100, 200 million ARR, okay, B2B companies. And they finally got a decent agent built. Okay, it's taken them for a while. But they have 10,000 happy customers, and they're pushing this agent out. And they got to break even last year because Scale and 20 VC aren't going to put any more money in, even though they're supportive, because the growth's not there, right? They got 30 million left in the bank. They're break even at 40, 50 million ARR. Now I'm competing with Decagon or Legora or whoever, and I need 20 more million of inference this year. Or it's game over because I can't compete because their agent is like the way I've deployed it is great, but it's at $2 per interaction, Rory. It's $2.50 per interaction. I need 50 million interactions this year. That means I need 100 million. Now I bring it in 50. What do I do, Rory? I can be competitive. You told me to get break even. I did that. Thank you, guys. Then you told me I got to be more AI. Thank you, guys. Now I built it. How am I going to fund the 50 million inference? Right? OpenEvidence has the money.
You have the irritating habit of asking exactly the right question. No, I totally, I'm mentally thinking of some companies that have gone through that. You're exactly right. It's like, hey, your SaaS product isn't enough. Let's get profitable. Okay, you got profitable, but nobody cares. You need an AI product. Oh my God, you've delivered an AI product. Your customers love it. And now you're at the next shoe to drop is, how are you going to finance this thing? Because you're up against people who can raise $200 million on a dream. And I acknowledge that. And rather than telling you I have the answer, it's an issue I'm wrestling with. And I can think of 2 boardrooms in the next 2 months, right? Maybe 1 month as we do annual planning, right? How aggressive can you be in this market? Because if you play if you try and meter it to your cash constraints, you're going to get left behind. So you better be, so the gut level comes, and this is how capitalism, I suppose, is meant to work. The gut level test comes if your customers are getting value from your AI agent that they can't get anywhere else, and you can make that value clear, then you can charge enough to pay for your tokens, and yay you. Right. If you're not giving value, or if you're locked in a war with someone else who has infinite capital and is willing to give it away longer than you, then you're probably going to lose, and you should figure out how to exit now. And to some extent, the mid-year kind of coding wars where, oh my gosh, Windsurf looked to exit. There was a little bit of that dynamic going on. Is this war escalating with a level of token intensity that you just can't keep up at? And I acknowledge that at the app level, as I say, a couple of my companies are wrestling with those issues right now.
Yeah, I'm honestly worried. We talk about is SaaS dead or what's going on. I worry this is the next final act. Is that you checked you did all the right things, right?
I did everything you told me to do.
You did it. You're not growing 0%. Your customers don't hate you. You built an agent, and the final nail in the coffin is we just can't afford the inference. We just can't build a competitive product. We can't, and even, earlier on this podcast, in essence, even Canva, which will be one of the great IPOs, even Cliff teased at that. I could build Gamma, but I can't burn the way Gamma burns those tokens. Now, maybe he'd say something different today, but it was the same point that echoed in my head that now we're seeing across boardrooms, across B2B companies. I think it's the final nail.
Is there a way out there? If you can't raise the money to compete, but you can't not spend,
Well, Rory hit the way out. There is a simple way out, which is you build an epically good agent. Typically one, maybe let's say your product's $5,000 a year, $10,000 a year, and you're able to charge $20,000 a month for your agent, $10,000 a month because it replaces 20 people. It's that good. It's not pretend that good. It's not that good on a sales pitch. It's literally so good that the ROI is measured in weeks, right? That's your way out. But the problem is a lot of B2B companies, they're just struggling to get parity. The bar is so high. And so, but that's the answer, but it's exhausting because it was so much work just to get here, to get to profitability, to get to agent. Now you have to beat the agent that OpenEvidence, Legora, Harvey, whoever we're going to talk about, you have to have a better agent than them to earn the 20 grand a month. Like your team better be the best.
To take another example that probably applies to even a large public company like Salesforce, who, yes, has infinite money, but also doesn't want to dip in the red. Or you make sure that a combination of, you have the advantage of the data that you possess to make it a better agent, to make it a more efficient agent. Maybe you have to do less processing. Maybe another thing is, so I've seen some of these companies using the open source models for a lot of it, so you can leverage that and get cheaper processing. Yeah, you got to do all those things. But more than anything, I think, Jason, you're right. You've got to deliver value such that you can charge for it. But in the end, I mean, look, the dirty little secret is in the end, everyone's going to have to deliver value greater than the amount of money they're going to have to be able to charge more than the amount of money it costs to make the thing. I mean, OpenAI may get to do that for longer than anyone else, but in the end, the wheels of capitalism do grind fine, and we're all going to have to pony up and cash flow positive.
But the thing is, listen, I don't have everybody's numbers for sure. The other advantage that the new entrants have is that if you have the best agent and you have the kind of market demand we see, right? Then your inference costs are a marketing cost. The established players don't have that luxury. They're already spending massive amounts on traditional sales and marketing.
Yeah, no, I hear you.
Versus, if Harry's had Harvey and Legora on. If Harvey went to 200 million last year, OpenEvidence 100 million a year. They have no sales and very little sales. Maybe Harvey does, but I can think of plenty of AI leaders that have 4 people in sales, and I can think of some that just hired a marketer at 200 million in revenue. So the inference is your sales and marketing team in essence, right? Because you just throw all the money into making the agent great, and I don't see how even Salesforce is one of the few that can do it with its resources, and even there, it's stressful. If you talk to folks at Salesforce today, they'll tell you this is the most stressful time they've ever worked at Salesforce in the history of the company.
One of the ahas from this is just the demand for inference, and just by extension, the demand for compute, and what does this say about it, right? And I always think, it's going to sound cool, I always I always apply, a certain discount factor to what, people running the large AI model companies say about demand, because they're talking their book. And even the poor fools like Oracle who are investing to chase that demand and sell them compute services, I'm like, maybe you're getting fooled by these other guys. But I always think the guys running TSMC are sharp, right? And they've been around a long time, and, they're cynical, which I'm sure you all saw that piece about 12 months ago. They were fairly skeptical when Altman's talking about we're going to need to raise $1 trillion. They're like, yeah, go away, AI boy, right? They just did their earnings call, and the comment was, basically demand for compute is effectively infinite right now, and they're raising their capex. And remember, these are not these are folks who say, I'm going to spend $50 billion. Peak before was 40, so low was 22 billion 2 years ago. They're raising their capex budget for next year, and they're basically saying, we think the demand is real right now. And to me, that's because there's been a lot of, and we've all been wrestling with it. Is there going to be a day when everyone says, we're not going to invest as much anymore, we're going to slow down just a little? Because you're so far out there going back to the Brex comment in 21, we're so underwriting hypergrowth that even the slightest slowdown would be kind of pretty brutal for the markets. And this was the biggest tell of all, because these are the guys who spend the capex with a 2 or 3 year lead cycle that services NVIDIA, that services the hyperscalers, that service OpenAI, that service the AI companies. So it's the very the first step in the AI pyramid. And the guys running that are saying, we're going to need a whole bunch more compute here, boy. We're going to need a whole bunch more capex, right? And it was just interesting because I think keeping an eye on TSMC as the people who would own the problem if they overinvest You can cut employees, you can turn off your GPU, but if you dig a big, deep hole in the ground in Phoenix and a big, deep hole in the ground in Japan and put a fab in there and no one uses it, you're out $20 billion. And they're leaning in right now. So that inference demand is pretty clearly there, according to all the tells.
For those that think about the AI bubble, does that not completely denigrate those risks of an AI bubble bursting? When you look at them, when you look at the improvements, when you look at Dario coming out today saying, hey, when you look at the improvements, we'll be replacing everyone's job in under 5 years.
Not every statement that says it's going to go on now has to be equally correct. A bunch of people who have the money, starting with the foundries, going to the chip companies and going to the hyperscale, have all said, we're going to spend this money this year. So I think it's highly unlikely that this is not going to be the year where people get terrified and say, I'm not going to do it. At some point, I think they will, because I think we probably are over-investing at some level. But right now, people are saying, I can see logic to this thing for the next 12, 24 months. Despite the massive gap between the CapEx is now 600 billion, the app's revenue, squinting is 100 billion. So you're still, 500 billion a year in the hole. But right now, people are saying the return is there. That's all you can conclude right now. If you knew when it was going to happen to the day, you'd be trading NVIDIA puts and you wouldn't be talking to Harry
I'm so sorry. I'm the least intelligent on this call, which is why I love doing it. When you look at the cost of inference maintaining its high price, and when you look at Jason, I think quite rightly saying that inference will be running 24/7 for more and more of the knowledge worker population, why is that not just continuing evidence that NVIDIA has so much more room to run and is actually underpriced today?
To take, for example, that statement, the cost of inference, the cost per token goes down enormously quickly, and it's just that demand expands and just people use more and more tokens to get to the same dollar amount, right? Just to be precise. So I think the only argument against what you're saying is some version of, as the numbers get bigger and bigger, you start encountering, GDP type limits. So your total US CapEx is X and you're now 30% of the total CapEx. Can we really stop building tractors, buildings? And can we put all our money into great big data centers? And some people articulate that vision. There are people who articulate on the Dwarkish podcast, articulating the $1 trillion data center. Well, maybe. I'm not sure that happens. I don't think you have to believe in the $1 trillion data center or all human beings are going to be unemployed by AI to believe in at the margin for the next 12 months, it looks more likely than not that people will continue on roughly the same investment trajectory. Those are both statements that have the same conclusion for the next 12 months, but are very different in terms of their grandiosity. Do you understand me? And I'm not making the grandiose statement. I'm just saying, let me make it really tangible. At some point, NVIDIA puts will be a great buy because every semiconductor cycle for the last 40 years has ended up in a massive downswing. I ain't buying them today. That's when the rubber hits the road, when people are done talking and they want to say they believe. And I don't have that conviction yet because people who have money and conviction are saying they're going to spend.
We all know that some version of the bubble will pop, even if it's well after SpaceX IPOs and we have 1,000 data centers in space, which is Elon's dream. And there's so much interesting things coming, 24/7 inference. It will pop someday. If we can't see it reasonably popping in the next 24 months, I don't know that as investors, as employees, as management team members, we can have dinner conversations, but I'm not sure there's much we should change. And I guess we all got caught around December 2021, where 90% of tech thought this was going to last longer, and then bam, we got it just bit us right into like the HashiCorp went public, and then it just stopped for 2 years. But this is different, and there's no upside in betting this is going to slow in the next 24 months. There's literally, at least for 99.9% of us, there's no upside.
To ground it in practicalities, the only thing you can advise people is, think about a scenario plan. Think about, would you have a plan if it were to change? Think about your funding strategy, especially if money is cheap, to make sure, going back to the Brex thing, you're really glad you raised that money in 2021, right? All you can do is play to the current scenario, but have a plan that if the world changes, you'll know how to change, and that you've raised money to be able to survive that. That's all you can do.
Speaking of playing the game on the field, we mentioned them a couple of times. OpenEvidence Raises at $12 billion, led by Thrive and DST. It's a 12x valuation step up to where they raised at $1 billion from Secure at the start of the year. Revenue growth has been amazing. pharmaceuticals ad spend in the US on media is $22 billion a year. If you think about the transition of that to their business model and assuming a reasonable take, you can see them being a $4 to $5 billion revenue business in that alone. Doesn't feel crazy, but then in other aspects it does. How did you guys read this one?
I think it's a great company. It's a perfect use case for AI. And it's one of the use cases where the general models are good, but the combination of specific relationships with Journal of New England Medicine and all that, plus restricting access only to medical professions, plus HIPAA compliance means you've got this really nice product to allow doctors to do decision support, which is go and check online, what's the recommended treatment for some obscure disease I haven't seen, right? And then the obvious thing you do with that is you sell them ads, right? And the obvious people to advertise to those doctors are the drug companies because they want to sell to the doctors, right? So it's a perfect business, and they've escalated to, I believe, $150 million in revenue, right? So I was actually impressed that you led with the market size, because the only question, so the things that are clear here is they're the winner in the space, right? Doximity is the old pre-Gen AI competitor. But in terms of, think about doctor media mind share for doctor-like things, Doximity helps you a lot with, thinking about salary, thinking about job. But I have a medical question to which I want a highly technical medical answer. They appear to have commanding market share. So you've won that business. So the only question is, how big is the market? And you're right. You can say total drug company spend on quote unquote drug advertising is 20 to 30 billion. But Harry, a good half of that is TV ads to consumers, right? So for a lot of these drugs, especially the long-term conditions, the advertising is not going to the doctors. It's actually going to the individuals who are wrestling with the disease, so they can build consumer preference. So that halves the market, right? And on top of that, if you look at pharma companies spend on trying to reach medical professionals, actual direct-to-doctor advertising is $2 or $3 billion marketplace, which is now getting a little bit smaller, right? And you then have a whole bunch of these, infamous pharmaceutical reps. So a lot of this marketing is done in person. So, you have the, folks just calling on doctors, bringing donuts, saying, hey, here's a sample pack of my nice new arthritic drug, give it to your consumers. So the only way this market, so for OpenEvidence to get to that valuation, what they have to do is one of two things. Either A, they have to blow open some of that budget away from, pharma reps calling on doctors and move more of that budget online, which, by the way, is a totally credible thing to do, right? But that's what they have to do. Or they have to expand into other services to doctors. And just like I think Doximity added some, for example, Doximity, a product they added that was a really clever product, is a scheduling app with a kind of phone number that doctors could use that wasn't their personal cell, because doctors want to give out their cell so people can reach it, but they don't want to give out their personal cell. So some nice little doctor products. So to get 3x from 12 billion, you probably have to do some significant TAM expansion. It's credible they do it, but they got to do it.
You got to be at $5 billion in revenue, don't you, on a 7x multiple?
To get to 35, yeah, that's a bit sobering.
I'm not a total expert, but based on what I do know about OpenEvidence, if the deal was priced right, anyone would want to do it. It's got the market share. It's very valued by physicians. It's one of the largest. They haven't figured out the true TAM, but the notional TAM is about as big as it gets. Of course, you'd want to do this deal at the right price, right? Anyone would do it.
If you were a growth investor, would you do it at 12, Jason?
Well, that's the question. This is the back to hubristic fundraising in the Brex round. Who at OpenEvidence is going to do the Brex round at $12 billion at OpenEvidence and 11 Labs and Legora and Harvey? When is that round? Is this that round, or is it the round in March at 30? Because this is hubristic fundraising. OpenEvidence will probably do a round at 30 or 40 next year. I'm actually going to suggest that Thrive is very smart, and they've probably done the math, and this is the right insertion point for them, and they believe in it. And someone else is going to do it at 30 to 40 next year as it goes to 400 next year or 500. Someone's going to do that. So who does the $12 billion Brex round here where nothing but greatness, but gets caught with the tail end of hubristic fundraising.
The first line really resonates with me. This is such an obviously good deal in such an obviously good market with a wildly quality founder who's had a win before. He sold Kenshu to S&P, big brain, PhD, AI AI native from his first deal, which was a financial AI company. This impeccable background here, great connections. There's nothing not to like here. And so you're right. Let me give you a clue. You're not going to find a discount here, people.
But you don't think this will be the $12 billion price round at Brex where the music stopped and it's that last high price?
It's always a tricky question because if you played back, remember they had a round at 3 and I think a round at 6. So this is the 4th time in. And every one of those rounds, you'd have said, maybe this is the one that's going too far, right? But when you step back, they 10x'd revenue this year and they 10x'd their valuation plus or minus, and so the revenue multiple is the same, right? I think that's the market we're in now, and at some point, someone's going to be left with tide. You're right, Jason. It's the Brex. You're running the Brex risk, which is the tide goes out. It's still an amazing company, but maybe you're doomed to a 1x. And is this the round that happens? I might have said the $6 billion round was, just given the core TAM market size. That's the bet, right?
What's so hard is, in the moment, it never feels that hubristic. And like we just said, it's a no-brainer deal, great market share, great founders. Likewise, I remember with Brex, I had Henrique and Pedro on the show back in 2020, 2021, and they were talking about Amex and the fragility and how they could build a $100 billion business. And $12 billion did not seem that crazy.
Does it? Hubris is like that.
And even more, these late stage deals of great companies, they're very easy to talk yourself into when times are good. When times are tough, they're still hard to talk yourself into. But when times are mixed today, but the good stuff is so good, it's so easy to walk into the partners meeting and advocate for open evidence, isn't it? It's just so easy. Guys, it's a little expensive at 50,000 times revenue or whatever it is, but you can't argue that this is a generational company. And Mark Andreessen says we do generational companies at any price. We just buy as much as we can. They only go up overall, not all of them, but they only go up overall. This is a generational company. I know it was 12 billion last week, but I propose 1 billion at 35 billion, guys, this week. It's a generational company.
You said Mark Andreessen proposed that. They released a report this week, which I thought was astounding for a couple of different things. But most importantly, one, they put out $8 billion invested in 2025. This is Andreessen's report, by the way. So to give context, Andreessen did a report. Incredible slides, I thought, actually. I thought them and Avenir did great reports this week. I'm sure, Jason, you...
Yes.
But in Andreessen's, they said about $8 billion invested in 2025. And the stat that blew me away, 2/3 of private AI revenue is generated by Andreessen-backed companies. OpenAI, Databricks, Cursor, Harvey, Replit, list continues. I was astounded by that. I don't know if you have takeaways from it, but I thought it was interesting for the audience to hear.
I thought it was an excellent report. And I thought there's a lot of substantive, good economic analysis up and down the report. I thought that slide was probably the least astounding one when you think about it for longer than clearly you did. Because it was a great soundbite. And those guys are the best market. It's a great soundbite, right? But objectively speaking, if you kind of add up all the AI revenue, you're going to get 13 billion for OpenAI, 4 billion for Anthropic, and everything else is in the noise. Right, 200 million for Harvey, whoop-de-doo. They're amazing companies, they're going to be great. But my point is, to a rounding error, the sum of the revenue is the sum of, and then actually, if you were to lump a third one in, it would be Databricks, which they have a massive market share in. So so to a rounding error, another way of saying the same slide is OpenAI. We have money in OpenAI, and OpenAI is 50% of total revenue.
I'll tell you what I found interesting about it. This, and then Gary Tan again saying that venture should be 10 times bigger. Smart guys, right? Is this really an asset class? Finally, the classic take in ventures, it's not really an asset class. It's a weird niche of PE. Yes, the top quartile, certainly the top decile perform, but the rest is a disaster. So it's not an asset class if the bottom 75% isn't even worth getting out of bed for. If Andreessen has proven this, penetration and AUM is repeatable, right? Like clockwork, and YC is doing it at the low end, is venture finally an asset class? If it is, that's Gary's point. Put 10 times as much money in. We have access to the early stage funnels, right? Andreessen's saying we have 2/3 of private AI revenue. There's an asterisk and a dagger to Rory's point, right? Because it's weighted on two names. But still, the point is that if it is an asset class, then you can deploy the maximum amount of practical capital into it efficiently.
I could agree with your conclusion on it being at some level an asset class. I might even argue two asset classes. I'm not sure that I agree with your conclusion that therefore you deploy more. I mean, I think that...
Well, Gary said that, not me.
Got it. Look, actually, at the Gary level, I agree, right, to be clear. Because now we're going to jump in a lot, but let's digress off on the Y Combinator. The slogan of Y Combinator from the day one is to make it easier for startups to start. Right, it's some more elegant version of that. Right, at the margin, it costs. There's no meaningful capital cost to giving someone 250 grand or 500 grand to have a go. Right, so the more people who start and try and do companies at the margin, it's a great thing for everyone, including the people involved. Worst case, people talk about risk, but worst case is you do it for 2 years, you fold up and you go back to your, mag job.
Back to college.
That's exactly right. And you're golden and you're fine. So as far as Y Combinator is concerned, and encouraging startups, the more the merrier. I think in terms of where I disagree with you is in terms of, I think venture is actually two asset classes. It's the traditional early stage venture that's existed for 20, 30 years, and this new late and later stage venture asset class that used to be called small cap growth and is now privately held. So it's two asset classes. I don't think in either case they benefit from excess capital, because I do believe that, Barton Biggs, I've said it before, there's no investing business so good that excess capital won't ruin it, right? And I do think that excess capital will make this business harder and to some extent erode the returns. And you're seeing that. 2020, it's funny, they said that 2021 was a very active year. I think 25 for Andreessen was the most active year since 2021. We had a reasonably active year in 21, not nearly as different. We do roughly the same number of deals every year. In retrospect, I wish I'd just gone home, right? If you didn't because if you think everything in 2021 was either priced wrong and makes a 1x, or early and just totally wrong and makes, less than a 1x, let's just say, right? Other than a few companies that were the early precursors of AI, So, excess activity is, not necessarily the best thing in an investing class. I saw the Druckenmiller quote, and it's for public investing, but it's been sticking with me all week, where he said something like, most of the time we sit around here waiting, reading, and thinking. And I thought, that's a real investor, right? And understands that, activity is not everything. What is true for them is that what they figured out is that the bundle product of doing early stage really well would allow you to bundle 3 or 4x more dollars later stage, and the combination of the two could be effectively managed and would be disruptive up and down the chain. That's the aha from them, right? That you can't, I did the math 2 weeks ago, and I'm doing it again. So if they're 18% of the funding last year, right, advertise that over 2 years, they're 10% of the Series A's. They got to be 10% of the good deals. They got to be 10% of the great deals. And they've structurally figured out a way to make that happen, right? So yeah, I think that's the victory lap from this. And they were, so that was probably one of the thing about them that struck me the most. And then the other stuff was all about, some version of what Jason was saying, which is, we're all still fine. The valuations are fine. It's expensive, but not 99 levels. And we'll see. Not
to be a little glum, but what happens if Mark or Ben step down, especially Mark, for a variety of reasons? What happens? Is that another option is to wait them out? This is an eponymous firm, and things happen. Even health scares happen, right? They do happen. A lot of people get tired. You think people are all excited, and then Deskin Moskovitz quits Asana out of the blue, right? You don't know. Smiles, everyone smiles. You just don't know. Can Andreessen Horowitz? I know everyone's going to say there's Martin and there's all these great people, but can it survive at this level? going to Harry's point, at this elite level, a generational transition, right? Can it survive that? Or is it always going to end up being those 3 generations to the gutter?
Yes. I would assert vigorously the answer is, can it survive? Of course it can. I mean, one of my favorite quotes, I think I've said it before, is, the graveyards are full of those indispensable men, right? And, let me just recite the names for you. Kleiner, Perkins, Caulfield, and Byers.
Yeah.
Kleiner still exists. Mamoon's doing a nice job. He's not Kleiner or Perkins or Caulfield or Byers, right? Firms that proactively manage succession planning, can make it happen. I mean, they've gone through 2 or 3 generations.
But this one is so, like, the world's changed, right? This one's so iconic.
But on the other, yes, but in a weird kind of way, it's harder. I'm actually going to push back the other. It's actually, and this is, I think, one of Andreessen's big insights. It's harder to be someone like Benchmark, small and brilliant, and manage generational transition, which is why it's awesome that they do it, because the asset is the brains of 4 or 5 individual people. The beauty of what Andreessen are clearly trying to do, and why I think they'll be able to manage it, is they're basically trying to transcend the individual by just being an institution. Their fundamental bet has been that venture capital is going to go the same way as investment banking. It used to be dominated by individuals and small partnerships, and now it's dominated by Mr. Goldman, Mr. Sachs, and used to be Mr. Salomon Brothers, right? And they all went public, and they're all just a very different business. That's the bet they're making. So, cynical comment, if anyone has a rational economic incentive to manage generational transition, it's that firm. Because Mr. Kravis and Mr. Roberts can settle into a comfortable retirement, drawing off the management team from KKR, provided those fine 40-something Ivy League graduates that they've hired to run their firm can keep it on the straight and narrow. And the economics to anyone building that kind of, as I say, equivalent of the investment bank that goes public, they've every incentive to do it.
Oh, yeah. I'm not saying that if there was an unexpected transition that people wouldn't make money, right? The question that Harry had, this apparent dominance right now, could that survive the loss of Mr. Beast? Right? Could it survive the loss of Elon Musk? Right? The core, the iconic core.
That's a
I'm not sure.
Question.
I don't know.
Yeah, I would not like to think of the Tesla stock price if Mr. Musk decided to move back to South Africa and retire.
The shadow of Mark Andreessen is even when he's quiet on social media, it's a long one.
Which generational transition would be harder for a firm, Andreessen Horowitz or Coastal Ventures?
Look, there's an insider baseball thing here that I'm not gossiping enough to know. I honestly don't know if Vinod wants to build a generational fund. Like he might, like when I'm just guessing as a brand guy, when I look how it's named and I look he has some of the best talent on the bench.
I thought Vinod's plan was not to die, so none of this matters.
It might not matter. It's a good plan.
Yeah, it's a great plan. I'm with him. And if he can figure it out.
It's a good, either for real or in the GPUs, one way or another, to not die.
If anyone will, he will. So Harry, we're going to avoid your question because I think we have a sense of what the answer would be. So I'm avoiding the question by stipulating.
If you're never going to die and you love the game.
He's never going to die, so
doesn't matter.
Rory, you'll remember that Jason said...
And he could just invest his own capital infinitely if anyone disagrees. Like he's going to live to 300 and he can just invest his own billions worst case, right? You don't need any LPs.
It's the year of longevity, so it plays very nicely into that. I do want to discuss public markets because we saw Equipment Share IPO pop 33%, $8 billion market cap, growing 47% at $4 billion in revenue. Great IPO. IPO market's open. We feeling great about this?
I think it's a good IPO. I think that, again, it points to, I think it points to the need for scale, profitability, and it's a very different IPO, obviously. Just for everyone's background, Equipment Share is a kind of technology-enabled equipment rental company for construction. So if you're a builder, a builder in, pick any U.S. city, and you're doing a job and you need to rent diggers, conveyors, whatever else, other equipment you need, these are the guys to go to, right? A great story, 10-year story, real critical mass, making money. It's inherently a physical business with a digital overlay. And at the end of the day, there's nothing digital about a piece of construction equipment. It's a large yellow or green painted thing that digs up dirt and moves it around. So it's a grounded business, but they seem to have built kind of, in large part using digital technology to become more efficient. They seem to have built a pretty compelling business. So go team. So it's probably good news for all the other $2 billion digital construction companies out there. right? But
growing 47% at that scale and profitable.
Growing 47%. I think it's
if you're at billions in revenue, growing 40% and profitable, right? And outlier margins for your segment, then you can IPO in an effortless fashion. Like this, I view this as an effortless IPO, which was interesting. It was effortless. It's really oversubscribed. You just IPO, you trade up. There's no drama. It's just, this is what an IPO is supposed to be.
And fun to see. It was a Y Combinator company from, I think, 2015. I would love to go back and look at everyone's notes as they sat through demo day 2015 and what they said about the equipment rental company from the Heartland. Because those guys
YC and Lead Edge both made a lot of money on that one. Does this start a floodgate of this size of outcomes going public? And do they see the 33% pop and a good IPO, as Jason said, and say, okay, market's ready now for us? Will this start a flood?
Well, Rory was saying, when I pointed out in the notes, I thought the contrast to Wealthfront was, here's one that wasn't good enough for the markets. And a very good company, a company whose software we admire, who has done some good deeds in the world, made more efficient investing very, very easy for people. Doesn't seem to rip consumers off in a lot of ways. This was an IPO that the market said shouldn't have happened. It's a deeply broken IPO. It's trading down 30 or 40% from its IPO, and it's subscale. Like, it's worse. It's subscale, right? The markets are saying, first of all, this wasn't worth remotely what we IPO'd it at. It's only worth 1.3 billion, not 2-point-something billion. It's down 36%, which sounds bad, but it's also subscale. $1 billion, that's nothing for OpenEvidence or friends, but that is not. You're barely public. You lose the liquidity, you lose analysts. We can say they IPO'd, but it's going to be a long haul for everybody to get their money out of this company, right? For employees, maybe it's fine, right? But it's barely public.
I still have a more than vestigial affection for this company. And, yes, it does kind of suck. And, some part of it may be temporary, but it does point to the low end of the market cap space is a perilous one because you fall a little below it and you do end up in that 1.2 but there are companies doing 5 million in ARR that are raising at 1.2 billion, right? And here's poor Wealthsimple, hundreds of millions in revenue, billions under management at the same space. I think they will compound out. I actually like the company and have a mental note here to go check on it and see the valuation and maybe buy some. But Jason is right. It's not going to be a liquidity event in the short term because there's just not going to be the liquidity. Again, it gets back to you can say it's fortunate or unfortunate, but it doesn't matter what your kind of subjective opinions are of it. The objective fact is 3 billion plus or minus appears to be the point at which it's easy to go public, and it gets a lot easier the more you go up from there, right? Maybe 3 is a cutoff, right? And when you do something at 2 and then you slip even a little bit, you're down into who cares land, which sucks.
My worry is honestly, if companies are created, maintained, grown by the people within them, do the best talent really want to go to Wealthfront in a 30 to 40% down IPO? I didn't mean that horribly, but it's just, is that a magnet for the best talent today, given the many options they have? And if not,
a genuine comment. I think if you're an AI engineer, no. If you're actually interested in finance and investing, I think it's a very compelling space to go because I think the things they're doing are super interesting. Do
you really? Is it a top 5 place? Like, no offense.
Well, can I give two? I think 2 things could happen. If you have a deeply driven and charismatic CEO on a mission, you will at least find a way to attract a handful of leaders to even a company with that struggle. You will find a way if you're utterly tenacious. I believe you will. They may be failed founders themselves, which is like the hottest recruiting category in tech right now, right? Failed founders. You may find them other places, but you will find 2 or 3 folks that can move the needle. And it's all you need. You only need 2 or 3 leaders at a company of any scale. The best ones will find 2 or 3. At the same time, I have to tell you, when I talk to companies like this, and I've done like several of them recently for the start of the year, I feel like people are just blinking at the camera. Like, they join these companies to not work. They join these companies so that I had to argue with one of these companies that I'm just friends with that, they didn't want to get a big release out this year. There was a lot going on to get a big release out this year. You're going to get destroyed by the competition. So on the one hand, you can do it, but you better be, in my opinion, this CEO on a mission and reboot the company and find those folks, but realize 90% of your folks, if you're not careful, are just going to be blinking at the camera. They're just going to be blinking at the camera. We need to slip that release. Well, these next quarters look soft, actually, Harry, but Q4 is looking great at the end of the year. This year, I know Q1 and Q2 are going to be down, but we'll make it all up in December.
I'm going to push back on this. Because we live in a power law out in terms of outcomes, we say only a few outcomes matter. Therefore, all the other outcomes don't matter, right? Which is mathematically true about company results, because that's the distribution curve for outcomes. But the distribution curve for humans, just for the record, is actually pretty much a bell curve, right? So the idea that, even in a good company, not everyone's going to be exceptional, right? There's an implied statement behind what you're doing, Jason, which is all the great people are in a great company and everyone in the okay companies is mediocre. I actually think there are two different distributions, right? Probably the great companies skew a little better than the average. But most of the time, once you're up to 1,000 people, you have a fairly representative subsegment of whatever, class of people you're hiring, right? So I don't believe that's along with, Harry's got his confused face on, and I can't explain it better right now, but I don't believe all the people in something like, a solid outcome company like a Wealthfront or even an Equivalent are, mediocre and not trying. I don't think that's,
no,
I think it's overgeneralization.
And of course, you're right. The reality is, even at the best, 80% of folks are not contributing significant value mathematically. But you got to have these epic leaders and ICs to compete
that's
today.
True. You've got to have a great leader.
It's so competitive. It's so competitive.
Yes, I totally agree, but great leaders are everywhere.
You better find this founder that can truly bring this talent in a magical way. And it does happen. We've all invested in a company, and often it's a company that plateaued and then reaccelerated. The CEOs find a way to hire through that plateau, right? That crappy 6 months. So we've all seen it, but you better not pray it's there because you like the product or you like how you used it in 2023 because it's brutal.
We said about my last one. We said about small and subscale IPOs. Ethos, the InsurTech provider, funded by your Sequoias, your Excels, provider of life insurance, going public today when this show airs on the 29th, valued at 1.3 billion, high end of the range. Last valuation privately was 2.7 billion in a peak valuation. Is that subscale? And as a result, should they not be going public?
They should. What do you mean by should, Howie? Why shouldn't they? What's your alternative plan for this company if it does not go public? Just curious.
Continue
Howie.
being funded by its existing investors.
But if its existing investors think that the return profile from here is more akin to what a public investor would want, then they can go public.
Sure. Does this not slightly feel like being fed to dogs? I mean, we all know that this is, if we're going to be
No, Harry, again, this boils down to it's a discussion we have every freaking week. It's,
it's
do you
below
want
the line for your math? Like, he doesn't care. And I don't think the world cares.
I don't plan, despite his $4 billion, I don't plan to run my life on where Chamath's lines are, right? I think it's true.
That's a quote. That's a good tweet.
Yeah. Please don't. I'm not trying to be argumentative. I'm actually being complimentary. Look, I think that what is true is that at this kind of valuation, at this kind of market cap, it is harder to get liquidity. It's what Jason said, but you don't know what's going to price. You don't know what's going to trade. And, maybe they don't want liquidity now. Maybe it's a process of starting, and over the next 1 or 2 years, they perform, they grow, grow 20% year on year, whatever it is, 30%, and you just, over time, build up your market cap. I don't think we can all stay private forever, being passed around amongst us, especially if we're not growing at, the venture cost of capital should be around 30%, and the public cost of capital should be around 11%. There does come a point when you're better off in the public markets. And if it's subscale and cheap, let me tell you what will happen. People will buy it, and they'll make what's called a capital gain. Just like if I have the courage of my convictions, I should go away, look at the Wealthfront numbers and say, I believe it's cheap at 1.2, I should buy. Because in the end...
So then
maybe a different version.
This is going to go out on the 29th, Jason, so we can ask Rory now, because he's just said about a capital gain that could come. Will this have a pop? Or will it have a drop?
Well, I think it's going to have a drop. It shouldn't. I mean, I still think notwithstanding Bill Gurley, my personal view is IPO should be engineered things matter. Just like the start of the conversation on Brex, it does matter to feel good. There's a lot of benefits to feeling good about the IPO. I think it won't. But I do think the interesting question is, maybe this is what you're asking in a sense, Harry. Rory may disagree, but in a sense, this is a capitulation by the investors saying we're not getting back to that $3 billion valuation or $2.something billion valuation of years ago. It's okay, right? We need liquidity. There needs to be an exit path. No one's offered to buy us for a good price in the last 3 to 4 years, or they would have taken it. So it's time, boys, to IPO. If this one works, will we see a flood of these, even if they're like Wealthfront or others and trade down? If the market will absorb them, will it be time to flush our 2021 unicorns out the door and down the drain, but out the door in 2026 and 2027? Maybe it's time to just let them go, no matter what price it's at.
You're veering on doing the thing you condemned others to do, which is sneering at a $1, $2, and $3 billion outcome, right? It's the low end of the public company market cap, but it's a perfectly good outcome and to be congratulated. To start a company from nothing and get to $1 or $2 billion in value, get it public, have the chance to compound for 5 or 10 years. It's an awesome achievement. And you're right. We're all just, at some point, I'm giving you, we will look back and go, the winners were the ones who got a crazy valuation in 2021 and then were able to get out from under that valuation via a down round, a down IPO, or a down M&A. The bad ones are the guys who are still sitting there looking at their 21 valuation and thinking that's ever coming back, right? So I give anyone credit who's making progress and clearing the logjam and doing what it takes. And yeah, I think is there going to be a lot more of this? I remind you, there's 700-800 unicorns, valued at more than $1 billion. And SVB did that analysis. I think something like 30% of them have a decent growth profile and scale. Call it 200. At Jason's point, at one a business day, it'll take a year. That was 2021. At one a week, it'll take 4 years. So yeah, I think this has to start happening. And one of the things that's true, Harry, is price clears all markets, right? In other words, there's a price at which public investors will say, yeah, I'll buy that. Right. And maybe it's not 2.1, maybe it's not the price you wanted in 2021, but if you want, you call it being fed to the dogs, which kind of clearly was a buried pejorative statement. Maybe it's just figuring out what price it takes to clear the product.
I guess just on a related note, I'm an advisor to a unicorn that's hundreds of millions, growing pretty good growth, right? Not being killed by AI, but not necessarily benefiting from it, but enough, right, to eventually compound to a better IPO than that. But not an OpenEvidence. And we did an M&A review a little while ago, and I was shocked who's on the block. Everyone's for sale. And I was shocked that folks worth more, much more, are willing to be acquired by someone with a fraction of their revenue. And these are, I didn't see Databricks, the ones that were passed around the room virtually, but I was shocked of folks that have been on 20 VC that I did not know were in market that are aggressively looking for an exit, right?
Which is why when you see people pull off an IPO or pull off a freaking $5 billion exit, the correct response is, yay, well done. And then B, goddamn, I wish some of my guys could do that. That'd be great. It's a great outcome, right?
Yeah.
You know what? If we're going to end, I do think a hat tip deserves to be given to our friend of the show, Mr. Mark Benioff, who Army just awarded Salesforce a $5.6 billion contract over 10 years. Like, Mr. Benioff, hat tip, well done.
Totally. Yeah. Software, SaaS is not dead, and now SaaS has an army. I love it, man. SaaS has the army, right? Yeah, take that, doubters. No, and it was, first of all, you're exactly right. Great outcome, and some sales rep in Salesforce is getting the mother of all commissions here, and good luck to them. But I also think it speaks to the whole zeitgeist of AI is going to eat everything, and I think the correct pushback has been, and you mentioned the people have been saying it's all these systems of record like Salesforce are going to get replaced. Yeah, are obviously wrong, because that's not what's going to happen, because it would be an incredible waste of talent to do that. You should just live off the systems that have. And I think this is an example of that. It's a separate comment, the Avenue piece, is how much value can you build in the AI first world as a system of record? That's a totally legitimate question. Can Salesforce get its mojo and growth back, or is it the utility of SaaS stocks for the next 5 years? That's a fair question, but I think deals like this put to rest anyone who thinks that they're going to vibe code their way to a product that can replace a $500 million army order.
I'm really sorry, Rory. I'm dumb as rocks still after many shows with you. My question to you is when AI sales reps work and you have distribution to the scale that Salesforce does, I don't see how they don't regain growth and be a dominant force again.
Interesting you should say that, because I was commenting on the people who are extreme, who are look, the market is saying, right now, the market is saying, oh my God, SaaS is dead, the multiples are down. And you're saying almost the exact opposite. Again, I would remind you that you can take some of your ill-gotten gains and bet them on the public markets if you want to. I think I'm kind of in the middle. I don't think they go away, but I think it's what Jason said. They don't go away, but it is hard to do that innovation that gets that new product out the door.
One thing that we do get confused about is we think it's all directly AI. And AI is the biggest issue because the lion's share of the new CIO's budget is going to AI, right? That's where all the discretionary budget is, and price increases. Okay. And price increases is almost self-defeating because it only works so long. And so if you're not tapping into the AI budget, that's, Mark, when he was on this show and his own show, was saying how much better a deal Palantir got. I think that was echoed in some of these Army contracts because maybe he had to take a haircut on those deals and get the budget where it is. And so it's there. It's just, there are so many other issues, unfortunately, that are attacking SaaS. Seat contractions are existential. Workday said seats are perpetually under pressure. Shopify has held headcount flat for 3 years and grown 40-something% in that time. We're not hiring anybody, and we're going to hire less people. Price increases have become destructive because SaaS price products are up 40% the last 3 to 4 years. And that's great for a CRO to make their plan this quarter, but it crowds everything out. There's no room to upsell or anything when price increases take up everything. And so there's like all these different issues. If we're not buying as many seats and we're radically increasing pricing, there's just multiple ways the old model's getting attacked. And if it were just as simple as adding an agent, that would be hard enough, but it's not. And our workforces are shrinking. And what we expect from our workforces is shrinking. And so SaaS will adapt, and we will get, but just magically charging per token doesn't necessarily change the fact for many providers. Tweaking pricing models doesn't change how much folks want to spend for a product, right? That's a fallacy. That's what consultants do. They're pricing consultants. It's great, but if no one wants to pay more than $20,000 a year for your product, you can't force them to with a clever pricing model. So there's a lot of issues to deal with that the new guys don't have to deal with today.
So you end up in that boring kind of quadrant of it ain't going away, but it ain't exploding. And
it's just, there's so many threats. It's so hard because there's so many threats. If it was just AI and it was nothing else, you put 2,000 people like Mark did on Agentforce and it works, or it doesn't, but it mostly works, right? But if at the same time folks are contracting seats, right? If at the same time they're cutting budget for existing investors, right? If at the same time you're beholden to price increases to make your plan, I worry for all but the best, it's too many daggers out. It's just being attacked from so many sides that it's hard. We just got used to these 130, 120% NRR years that were magical, that often didn't even rely on price increases, right? Slack never raised prices and still grew at 140% NRR. I don't know those days are ever coming back, no matter how good our agents are.
Okay.
Boys, time to wrap, baby.